Welcome to Equity.Guru, everybody. This is Chris Parry, your founding father, talking to Keith Driver, CEO of Replenish Nutrients, formerly EarthRenew. We'll touch on that briefly, but I know that this is a company that has gone through some things over the last few years, that has found its feet, I think it would be fair to say. But looking back, would you have done things differently?
I'm sure we would have. I mean, where I came into the story, the original EarthRenew 12 years ago went into bankruptcy, different business model, different plan. And when this lawsuit settled with Agrium, now Nutrien, I was given a flash drive, a pallet of documents, a storage locker in Colorado, and this asset, this power generation asset. So it took a couple of years to sort of figure out what we had and where our position in the marketplace was and how we got there. And then we went public in that process. That was a bit of a learning curve for us, where we really hadn't honed our message, and our story hadn't really been sorted out yet. And that was a bit of a bumpy ride, but we're now back to the part where we've got the wind at our backs. We've got, our sales are up. We've got a business plan that shows continuing 200% growth. So no, I don't know if I'd trade the experience. I think there's an easier way to have done it, but the pieces and the people that we've accumulated and the learning we've had in the market, particularly now when the macros are so good on fertilizer, have really, we're kind of lucky to have got here. But the journey was a bit rough.
So I guess a rough journey allows you to learn some things, try some things, and fast failure isn't necessarily a negative in the tech world. Do you consider yourself a tech company?
We are. The challenge is our technology deployment scale is annually. So fertilizers is a year-over-year business.
Got it.
And I'm used to other tech plays, which are day over day, month over month, sale over sale. And so our technology takes a bit more to understand, because the story plays out to some people in slow motion. We're a technology play in that we've got some fundamental technology about how we make our granules that allow us to have a project that's differentiated in the market. But we don't sell the technology, we sell the output from that technology. I just got back from the US, where we're looking at opportunities to partner with folks to accelerate the adoption of that technology without giving up what to us is the holy grail, which is our product and our market entry and our branding as we move into it. So we're looking for partners to partner with us because they can deploy our technology. They have certain asset bases that we'd be a good fit, lowest capital cost, no dilution. But it really just allows us to expand the influence of that technology across the markets.
So let's talk about the tech a little bit, or at least as much as one can, without betraying your moat. So traditional fertilizers out there, not the best when they get into the groundwater, not the best when they're laying around in the land. Your regenerative fertilizer, explain to the folks who have never set foot on a farm why it's better than the existing products.
Sure. So the example I'll give is, if you've ever been into, in the backyard, into a forest, and you see the path, and the path is compacted, there's nothing growing in the path, it's unhealthy. That's what chemical fertilizers do. The soil tilth goes away, so it compacts. You basically rub off and kill all the nutrients, and there's no microbial activity. But right beside that, you have it healthy. So what we do is we get people off the chemical fertilizer train, and there's two things wrong with that. One is chemical fertilizers are made by acid-base reactions, and that creates a chemical salt. And we don't put chemical salt in our gardens when we want things to grow. We don't put chemical salt, in the water when we want it to taste right. It's an inhibitor. So we've been putting down year over year all this salt into the soil, and that's what's causing those white patches you might see as you drive through the countryside. So you're flying into Calgary and you look down and you see these sort of white patches, and it's July. It's not snow; it's just salt pooling and alkalinity that's created there. So we get rid of that. The other is there was just this announcement from the Liberals and federally in Canada, 30% reduction in fertilizer use. Well, it's actually 30% reduction in nitrogen fertilizer use. And the reason people need more and more nitrogen is because there's less and less nutrient available from the soil. So you just keep spraying more stuff on the plant to get it to go, as opposed to dealing with, it's like treating a symptom, not the problem.
Right.
We treat the problem. The more you put down of our products, the less nitrogen you need. So for farmers looking to go to that 30% reduction, it's a tailwind to us. Use our products, regenerate your soil, and you won't need that 30% that you're not allowed anymore. So not only are you complying with the legislation, you're spending 30% less, and your yield is as high. So that's what our technology does. It brings back the soil, it puts back the minerals and the value into the soil, and thus you end up with a healthier plant, less pesticide use, less salt in the soil, all those things that help get the soil back to a more stable environment to be able to handle the growing of the plants that you're looking for.
So considering where the world is right now, where the Russians are stopping Europe's breadbasket from being a breadbasket, where the logistical problems and supply chain are impacting food supplies all over the world, how is your stock down?
So we're, I think there's a couple elements to that. One is I don't think the market understands where we're at. We get a lot of people like, well, why aren't you profitable yet? And why was your Q1 numbers down? Well, I'm like, well, you don't sell a lot of fertilizer when there's snow on the ground.
Right.
So, in fact, it's illegal in some places to put fertilizer down in those times. And it's almost impossible for the farmer to get that into the soil. So we don't do a lot of sales in Q1, Q2. You have to look at Q1 versus last year, Q1, 200% more. Q2, which is coming out soon, versus Q2 of last year, 200% growth. So quarter over quarter every year. But farmers, there's only 100 frost-free days in Western Canada. So as soon as the frost is off and then the soil dries enough that they can get on there to put the seed down, they're putting the seed in. In the fall, they got the crop off. Now they've got 2 or 3 months until the snow falls where they can put down fertilizer. So almost all of our fertilizers go down end of Q3 of Q4. Last year, 50% of our business was in Q4. This year, we're lining up to do a little bit less in Q4 because we've the innovation we put into our sales channel this year was 50% deposits. So we're recognizing revenue earlier, and we're just evening out the cash flows essentially. But 50% of our product gets delivered September through December, and actually probably more than 60% this year. So from a volume perspective, and because we keep growing, and because the disaster in Ukraine, and they can't get potash out of Belarus, and there's all these other problems, we're actually we have had to staff up and all first world problems just to make sure we can push all of this product into the market. We're going to be supply constrained again. It's not going to be whether we have customers to sell to, it's which customers are we going to disappoint at the end of this year and still get to that 200+% growth, which, I can't, then you look at the other part of the market fundamentals. No one's trading on fundamentals right now. The analysis we've had done would suggest we should be trading at 4 times top line revenue. So we should be valued at 2 to 3 times what we're valued at right now. And by the end of the year, if we hit our target, we should be valued at 6 to 8 times that time. So we've got to get through get our Q2 numbers out. That's going to show that we're more than halfway to our target. It's going to show that we've got the inventory to sell through the fall. People are looking at that, and then we're starting to build the Bolt. We got our pricing into that yesterday, so that project's go. We raised the money for it. We're ready to execute on that. So start getting updates on that. So there'll be really 3 themes of communication for investors to pay attention to. One is the science in the market. So our trials with customers, and what we hope to show our customers: same, if not higher yield, lower cost, lower salt. So same product. We're not saying, oh, we've got the best product, going to double your productivity. That's what the chemical guys do, because there's short circuiting things. We're going for the same result as the chemical fertilizer, but we cost less. We're putting less salt down. We're putting carbon in your soil. So that's what that theme is going to show, and more customers and bigger market that we serve.
So I'm guessing that if you weren't in a mode where you're trying to establish your credibility amongst your potential customers, that you'd look at the landscape here and just say, well, we've got more people want our product than we have product. Let's raise the price by double, triple. We'll still get it. We'll make a bunch of money, but we'll also piss everybody off for next year when things are more competitive.
Yeah, how we price our products is we look at all the chemical fertilizers, we map out their price, and then rebuild our products based on the same dollars per pound of nutrient, so that we know we're priced in the market. And the market's gone crazy, but we are still 95 to 100% of the price of the product. So there's a slight advantage to the farmer for trialing our product this year. Next year, we can go to 100 to 105% of market because they know it's not hard. We didn't have to get over the hump.
Yep.
We delivered on time, all those good things. And we've seen that year over year customers. So we're not trying to gouge in the market right now. In fact, our margin on a dollar basis stays the same, but our percentage margin this year is going to be a little bit smaller because the price is twice as much.
Right.
Farmers don't give 30% margin. They give basically $100 margin, no matter what the price is. And so we're right there. I'll take the additional volume. Price will move, our cash flow will be better, but our margin itself will remain dollars for dollars, the same dollars per ton, not necessarily quite the same percentage. Still 20% is our target for the end of the year, but it won't be the 26, 27% that we were hoping for. But it's not because we're making any less money. It's just that the price of our product moved up and we can't pass through the margin on that extra cost.
Sure.
But that's fine.
But I mean, in a standard tech company, if you're in a software as a service, people would be seeing, the ability for you to scale and grow as being a great place for you to be churning any profit you have back into the company. So there's no real difference here. It's like you're building out your potential productivity. You're establishing yourself in the marketplace. You're not killing anyone along the way.
Well, and most SaaS businesses don't make money if they're growing at the rate we're growing.
Yeah.
And it's because you're always hiring for 3 months out. We have to hire for 6 months out. So, but you'll see us, we hit net cash in Q4 last year. We'll hit it again this year. Like for the year, we'll be fine. But Q1 is always going to be terrible. It's like an ice cream store in January. Like, How come you didn't make a profit? Well, it's January. Like, look outside. But then come mid-July, when there's 400 people lining up at the door, that's what we're looking at. That's what we're seeing.
That seems to be a fairly Canadian problem, which would point to maybe the need to expand southward as quickly as possible. Is that on the cards, or is it more important to establish yourself in a controlled environment that's local and easy to access?
Sure. So I just drove to get back here for this interview. I just drove 12 hours straight north. So our BD efforts are pointing south, okay. Pacific Northwest into California through Colorado, and you can sort of see this track. Partly because the crops and the soil types and the nutrient availabilities there's a pattern to it that you can follow. So they're not necessarily going to be the exact same product in Oregon as it is here, but it is a slight change in the formulation, not a difference in the microbiology or in the technology or in the manufacturing. It's just saying here it's a 0.3530, there will be a 0.2537, but it's, we're taking the same things, putting it into the same granule. They'll be called slightly different names just to prevent confusion, but It's the same product family, but just recognizing which of the nutrients are already available or are rate limiting in that, or crop wise. There's different needs for potatoes and sugar beets and canola, and we're just going to keep rolling south, and ideally with some partners to help us, particularly with the end market delivery, like we are doing now with our distribution partners, just more and more distribution partners, and then following that up with production filling in behind it.
Now, obviously, in order to satisfy the potential demand, you've got to ramp up on your production side of things. You built your pilot plant, you proved everything out. You expanded the pilot plant to move into the demand. What's the next step now? You have $10 million in your kit.
So we've got about 20,000 tons of granulation capacity. The DeBolt project we financed is another 50,000 tons of granulation capacity. Behind that, we've got a target of between 50 and 70,000 tons of blended product. And that's not in a granule. It's the same product, but it's put on with a spreader. And we don't get quite the same margin for that product. But when we look at market entry, the cost of going into, like we did in DeBolt, going to the Peace region, you make blended product, people get the product, they like the product, and then you work on the form of the product to get it in the ideal form for them. So you have to discount a little bit to get trial, but then you know they want it, and then it's just a matter of delivering it in granule. So we're looking at that same our same growth. So our plan was 40,000 tons to 400,000 tons. This year we'll be at about 80,000 tons, probably year over year. Right? So we'll have done our first 200% growth. The DeBolt will get us to 130, and then the project in out in Bethune, Saskatchewan, will get us to 250, call it 300 by the time the actual blended capacity follows along behind that. So I can see our way from 40 to 400. I'm all the way at 300 already, and my meeting south, we're looking at the next 100,000. So we're and our average price that we use for our modeling, adjusted for commodity spikes, is $500. So people looking to do some top line math, saying, well, if you hit 400,000 tons at $500 a ton, that's 200 million in top line revenue. That's the North Star for us right now. And I could send you the GPS coordinates of where all that production capacity is going to be. This year on blended, we went from 2 blending sites to 7 blending sites for the fall. We're going from 1 granulating site to 2 granulated sites. Much easier to build larger granulation sites, and the capex for a blended site's like less than 100 grand. So we've got these 2 tranches that are going to show growth, but that's what's going to get us to 400 grand by 2026, maybe 2027, by the time it's all, online and producing.
Meanwhile, you're a $7 million market cap that just took in $10 million in cash.
Yeah, so it's one of the funny things with this. A lot of the reporting groups that do our, there's 140 some odd million shares outstanding at 17 cents a share. So that actually puts us in that $22 million, $24 million market cap. Okay. But to get all that corrected is like a life's work. I don't understand where they're all pulling their data from, because it's all unsteady and all these things. But
even with the $20 million market cap, $10 million in the bank, you're not dying of debt. It almost seems like an arbitrage.
And for us, so the worst part about being the CEO of a public company is you can never go out and buy your own shares in the market, but you have the best sense of why you should be. Yeah. So, I would encourage people to look at the fundamentals of our business, the growth year over year. Look at the multiples of the comps that are out there for us. So look at if you had, our margins are the same as Nutrients. Admittedly, they're doing a larger volume and they've got incumbency, but their pace of growth is stagnant largely. Like it's almost all sort of little acquisitions and the other stuff. Our core business is growing with these massive tailwinds. So that's our plan for the next 6 months, is to really spend our time helping people to read it. It's one thing to say, well, I can't believe you don't understand. Like that's the blind man's view. Is for me, it's to get out there, spend more time at conferences, more time telling shareholders and prospective shareholders and institutions why we are what that investment they need in the ag space that aligns with their ESG goals, that shows the growth that they're all looking for, and frankly is the sort of undervalued story that they all hope to find one day, because they can look like heroes when it grows really quickly. Right. And if I do a good job of that and build a good fundamental business, by the time our Q4 results come out this year, we'll be having a much different conversation about how we feel about the value of our company.
There are a lot of, let's kindly say, bullshit ESG plays out there that are designed to attract ESG investment rather than actually do good. It seems like yours is one of those on the other end of the spectrum there, where it's obviously clearly legitimately not just better for the environment, but the standard in your industry is so negative on the environment. It's like it makes me think like injecting a painkiller into an athlete's knee to get him through the next match rather than fixing the knee. Like eventually that knee's going to blow out and you're really screwed.
Really screwed. It's an interesting analogy to go for as a guy who used to be an athlete, but who had knee surgery. Fundamentally, it's hard to explain why we're ESG. Our manufacturing process for the nutrients is a decimal place less in GHG intensive than our competitors. So we're less than 10% of what they are footprint wise. Our product puts carbon back in the soil as opposed to putting salt in the soil. Mm-hmm. +1 for us there. And then our supply chain. So we upcycle the compost. So that's compost that material that otherwise go to landfill. It's being upcycled into compost. We're the market for that compost. So if you want to divert organics from landfill, you've got to find something to do with the compost. That's us. We put those microbes back into the soil. We upcycle our sulfur out of the oil and gas industry. So this is blocks that are sitting there, but sitting there, you can see them from space. We take the byproduct from potash production. So all of those are sort of play to that. And then, we haven't gone headstrong into, well, we need to have a carbon program. We'll have something this fall, but we haven't gone there because so much of it is just like, it's just shiny balls. And I come from, my background is, I got 2 degrees in environmental engineering and an MBA in environmental management. I used to teach carbon at the University of Calgary MBA school. So we're not going to put out a program that's not going to deliver value to our shareholders and to our farmers. There's too much smoke. There's just too much smoke and mirrors that we're going to come out with a fundamentally grounded program that allows value to be achieved as opposed to a gold star to be put beside the name. Ideally, replenish nutrients, regenerative farming, like these are mother's milk type activities, and that's our gold star. We know we're good. We just need to show how we create value from that, real dollars, and then I'll be happy to put that in front of folks and say, see, here's how we are. Here's what we do.
Well, look, as much as having a share price that's dragged a little is an annoyance, I do like the idea of working for the long game and proving yourself out by actually like demonstrating the worth of the product rather than just telling people what it will be one day.
Yeah, and that comes from this private equity background that I have, which is build a fundamentally good business and now tell everybody about that, give them the transparency they need, and let those folks value it. And those that do would realize, well, today's the day to come in and into the market because I understand, I see what they're actually doing, not what is just the sort of, streams of consciousness that go out there that say, well, of course we want to do this, but
it'll be used for magic mushrooms one day.
Yeah. So we're looking at sort of fundamentally, we're not a story, we're a business.
Right.
And so we don't want to just tell a story. We want to tell the story of the business because the business actually tells its own story. Revenues, growth, new markets, new partners, new products, just all the things you would want in a business that you were proud to be part of. And at the same time, can see how each of those elements drives revenue back, year over year revenue back to the farm.
So I like to look at potential risk of going to zero before I invest in a company. I see your product is out there being utilized and getting good results. I see your early stages. You proved yourself out again and again. You've raised money with no problem in a market that is shitty for raising money. You're not at any risk of running out of cash anytime soon. People aren't going to stop eating. They're not going to need to stop using fertilizers of some sort. So where in your mind would the risk still lie? What is the dark horse of the Armageddon for you?
Sure. So the dark horse that everybody perceives of us, I'll start there, is that, well, you're just doing good because commodities are doing good. And I think we're effectively a tolling business on the price of commodities. We take about 2 months of commodity risk between the time we order and pay for our ingredients and between the time we get paid on the back end. So we got about 60 days of exposure in the market compared to all the other egg plays that are, so we are not commodity exposed. So we'll make the same margin on a dollar per ton basis today as we will when the market inevitably in 10 years bottoms out in its cycle of whatever. And so we've built that to get rid of that risk. The actual risk to us is actually one of execution. So 200% year over year growth is hard. We were a small team and now we've got to expand and people got to silo, people got to execute. And if we just focus on that, the other bits will sort of take care of itself. We've got this maybe 3-year period of projects and execution, and we've just hired a new EVP of finance to help provide the controls to make sure that we don't go spending like drunken sailors in this overly ambitious growth.
Yep.
So we've got the controls in place. And if we can just do that 3 or 4 years from now, then I'll focus on, okay, let's tighten and demonstrate the margins without having to do these adjusted year over year while you're commissioning this and that kind of thing. Yeah. So we're focused on top line growth and growth of gross margin on a dollar basis. And we're focused on building a team that can support a 10x growth in the next 4 years. but we're already 1 year into our 4 years. So that's, if we do those things right, those are the risks. And right now, people are talent is an important resource for us. We've got the money, so at least that keeps the talent around. They know they have the money to do the job that they want to do. And then we've just got to execute on things like improving our working capital facilities because we're growing so fast, and making sure we're doing those things. Those are all smart people doing good work can make those things happen.
Those
It's
are process things.
keeping those people together
Yeah.
and keeping the vision tight, and not being distracted by, oh, the share price is down by half, we should do half the work. It's like, no. Now's the time where we all get paid. Management pre this raise owned 28%, 42% amongst insiders. So we are working for the shareholders, and we are working for ourselves, because we, 25% of everything that goes good in this company is going to come back to management. So we just need to think about how we do that and execute on that. And that gets me excited. I'm a 1 to 5 kind of guy. There'll be, when we hit 300 million in revenue, there's probably a different approach we need to take. But for now, it's growth, controlled, steady growth that keeps and builds an organization. And $200 million a year in revenue. I look forward to that day. That'll be quite the outcome for us.
And quite frankly, I think knowing what I know about your company, the share price right now is it's a gift to potential investors. Jump on in and hang on for the ride, man. It's been a pleasure as always. Let's make the next one sooner than the last one.
Perfect. Great, Chris. Thanks a lot for the chat, and anytime.
Thanks, man.
Appreciate it.
Appreciate it.